Okay. Okay. Yesterday I was in this lecture theater room, but sit on the other side as a audience. I found out that the speaker really don't need the microphone over there. Just the speakerphone microphone like this is pretty good. So in that case, I would save that microphone over here. Before we get started, we have a few household issues housekeeping issues that I would like to announce is after last Friday. I know that everyone had an online quiz, and I received comments and concerns from a couple of students. And then we have a discussion with department director for teaching, and also with the department chair. And here is what we could update. So basically, what we're going to do is to make sure that the students have about 1 week time to read the lecture notes and prepare for the tutorial questions for the next week. So this is what we're going to do. We are going to upload the lecture notes for the week T+1. You get used to this. This is academic definition. T+1 and tutorial question for the week of T-1. So it's last week's tutorial question and the next week lecture notes, and the week T will be on Moodle by Wednesday morning. So Wednesday morning, so Tuesday we're going to finish the lecture. We have some time to revise our lecture notes, and also we'd get rid of, refresh all these things to the next week. So we'll be on Wednesday morning, week T. So Wednesday morning when you wake up in general is 8 o'clock, and we want to do that before 12 a.m. between Tuesday night and Wednesday evening. That's what we're going to do. So in case there is some computer glitch, so sometimes we cannot really upload to the Moodles, then we're going to have enough time. I usually wake up 4 o'clock to 6 o'clock in the morning. So is my co-instructor here. So we're going to put that lecture notes. So 2 time spots. It's Wednesday morning. You're looking for something for the next week. And on Saturday morning, that's the second bullet points, solutions for all the tutorial questions and examples and questions in the lecture notes. So there are 2 solutions. One solution is for the tutorial questions. The other solutions is for all the examples and questions within the lecture notes. Will be updated to Noodle by Saturday morning at week T. So it's the same week's material will be updated on. So we finish on Friday in the morning. And allow us to update some information in the afternoon. And you should be able to find those solutions next morning, which is on Saturday in the week T. So that's 2 updates. So I try to make sure that students get this information. So there is try to iron out all these wrinkles and the confusions about when is this material be available on the Noodles. That would be our update. Because of the midterm, we are required, as an instructor, we are required to hold 2-hour consultation for each week. So for example, for my consultation hour would be 1 hour after each lecture, either on Tuesday, both on Tuesday and on Friday, just after the lecture. So that's going to give the students, because you have the questions, you may have the questions right after lecture or within the lecture. So it's most efficient time for you to ask these questions, and I'm more than happy to address those concerns and questions after the lecture. However, during our discussions, we know that for some students, maybe they have to attend other classes, which is at lunchtime. And also because of there is a midterm coming next week, so I voluntarily I did 3 more hours consultation this week. One is on Wednesday, the other one was on Thursday, and there is additional 1 hour today. It's I sent it through the online post. If you read that BF 5925, it's on the online. I think it's a 3 to. It might be the 2. Is it either 2? I think it's a 3 to 4. Yes, 3 to 4. Because of 4 to 5, I have booked another department appointments. So that would be the 3 hours. And in the future, I would move all the consultation location to the H397. That's a consultation room that you should be familiar with. So that going back in that room, we'll have a relatively classroom that we can sit down, we can talk, we can check the books. So that would be my consultation especially for the midterm. Several students mentioned about the recording on Friday. And we are informed that video on Friday is quite important. At least I received about 3 to 5 emails concerning the recording. The video file was not found. So we do the communication with the students and also with the administrator of this building and the teaching building. And it's find out that video recording on Friday, we don't have any control on that. It's a systemic, it's a system controlled by, I think it's an automatic system. Right now I'm recording, I'm supposed to be recorded at this moment. So we don't have any control, but we try our best is once you find that the recorded file is not available, try to let us know. And we're going to pass that information to the administrator, so they're going to fix it, make sure that the next one would be available. So the alternative measure to fix this is I will going to put as much information as possible in the lecture notes. So that's going to allow us in the afternoon after Friday, we try to put as much information that we have discussed, talked, and lectured in the morning's class in the lecture notes. And the students should be available, those lecture notes should be available to all the students by Saturday in the morning. So that's the 2 time spots for this one. Also, I received some comments and concerns on the first online quiz from quite a few students on Friday. So I've already passed that information, comments, concerns, suggestions to Dr. Enju, okay, who is the chief examiner of this unit. And also the last one is we're here to help. We know this is the MBA course. This is a first level MBA course. It's a combination of a little bit of the theory and the empirical. So what we want to do is we try our best to help here. So if any of you feel that we can be of any help, for example, if the students say, I really don't understand the NPV and IRR, well, that question should be solved a long time ago. But if you still have that kind of a question, please do not hesitate to come, any one of us. And we need iron it out, because otherwise it will be a little bit difficult for you to move on in the future. Okay, so that's basically a few housekeeping issues that I want to start with. Any more questions about the logistic? Any concerns, suggestions you might want to raise at this moment? Please feel free to. Okay, if I didn't see any, then I would move on. I would open the the door of communication open, and if any of you still have any concerns, questions, suggestions, please feel free to send us email. We appreciate it on that. Okay, let's go back to the tutorial questions. So last week we prepared for 3 tutorial questions. As a matter of fact, CAPM model is one of the most important theory and model in asset pricing of finance, let's say. There is another important theory in corporate finance. So basically, the subject of finance, or the other name is financial economics, is built on 2 major pillars. One pillar is called assets pricing, and the other pillar is called corporate finance. Of course, if you further develop the pillars, we can have a third one, which is a market microstructure. So that's basically 2 or 3 pillars we're talking about. And in the assets pricing, there is a very fundamental pillar is built on CAPM, and that's one of the theory that we discussed last week. So we prepare, even if that's an important theory, what we expect the students to understand is we try to students understand the lecture notes, and then we try to hammer down or enhance the understanding by the 3 questions. The first question is about general description or understanding of the CAPM model. Second question is about given the understanding of the CAPM model, what would be able for the students to use the CAPM model as long as we have certain information available. And the third one is try to criticize the understanding of CAPM model. For example, if the CAPM model is correct, then how do we adjust the understanding between or estimation between the return and the risk exposure? So that's the purpose to design the 3 questions for the tutorial. Now let's go to the first one. So that's the solutions. The first one is CAPM, describe the capital asset pricing model and what it tells us. So in terms of one student asked the instructor about in the midterm, their short-term answer, the short answer questions. What kind of a short quote by quote is expected in the exam? What I can give you a relatively reference about what is so-called short answer. Is something that if you write something in the exam answer sheet relatively close to this one, which means either slightly longer or even shorter than this one, and if you have a few keywords that is consistent with the suggested answer here, I think you should get a full mark, full credit on this. So let's say, describe the CAPM assets pricing model. CAPM assets pricing model is to describe the relationship between the systemic risk and the expected return. So what the keywords here we're looking about is systematic risk. That's a keyword we're looking. And also expected return. Okay? We're not looking at any return. We're looking at expected return. So if you have those keywords, 3 keywords, put onto the answer sheets, basically, I think for the first question is to describe the CAPM assets pricing model, you can get full credit. Okay, so that's the expectation here. And also, that's the same expectation as you moving forward on the market in the interview. During the interview, people ask you, what is a CAPM model? And the CAPM model just relieve or discover or deliver. So those kind of words are they relatively the same. But then there are two words that interviewer are expecting. First of all, is the exposure to the systematic risk. And the second of all, it's the relatively or expected return. And if you want to further say something along this level, then you can say it's individual assets expected return and how that return could be explained by the exposure to the systematic risk. If you can answer the question in this way, that's going to impress the interviewer even more. Okay? Because what's the added value? Because you mentioned this is the relationship of individual assets, and then the factor here is the market value. You didn't even say the market value in the word, but you mentioned it's a systematic risk. And the interviewer knows this is about systematic risk is coming from the market portfolio. So this is some expression that I want to say. They have the minimum. For this one, it's just a bare bone answer for that. If you answer this one, nobody can take a credit from you. But if you want to impress, then you can go even further. Has to be individual assets, their expected return, and how this expected return could be explained by the systematic risk. How to measure systematic risk? We have the market portfolio. It's called the market risk premium over there. And the relation is measured by the beta. What is the beta? It's the exposure to the systematic risk. So you can see that we extended the bare bone answer to 5 or 6 sentences, which is going to enrich your understanding of the CAPM model. Okay, so that's what we want to say about the first question. And what it tells us is the model tells us that the expected return on an asset without the exposure to the systematic risk equals to the risk-free rate. What does that mean says is we have the CAPM has 2 parts. Okay? There is a first part. There is a second part. The first part is first piece is all the expected return come from one piece from risk-free return. That's the first piece. And the first piece is always there. First piece is always there. Why is over there? Because we're talking about the market. The market including all assets. Risk-free asset is part of the all assets. But if you're talking about anything beyond the risk-free assets, then you add some risk over there. And how to describe the risk? The risk is coming from the market portfolio with risk-free assets and the risky assets. And then the relationship of individual assets to the market risk is coming from the second piece, which is measured by the beta. Market risk premium, as we identified in the parentheses, in this parenthesis, are the same for all different individual assets. So what makes cross-sectional variation of the individual assets is coming from this one, the beta. The beta makes a difference. Okay? So what we could further say about this is empirically, if we calculate, the next sentence say about is the exposure to systematic risk could be positive or negative. I think everybody understand the positive. Someone may wonder why there is a negative, right? So why there is a negative over there? There is a negative because that is going to provide diversifications, right? There are diversifications. So in the market, we originally last time we talking about the market, if we shift away from the mean variance analysis, you remember when we calculate the covariance, and if we add in the three assets, we show that formula very much. So when we measure the covariance, you need to have the three assets to show the covariance, to show the negative covariance here. Is that the rho could either be positive or negative, right? You add another asset to the existing portfolio, that's going to add in n rows that is going to link to the existing assets. And that row could be either positive or negative. And that's why we have this beta could be either positive or negative. That's the second level. And the third level is empirically, if we calculate the average, the beta of all stocks, has to be all stocks. So let me clean out this one. Clean out this one. For this answer is average beta, all stocks listed in US market for a relatively long period of time. That's the three keywords here. The average beta would be very close to 1. And why is that? So remember, what's the exposure of the market portfolio to the market portfolio? The question sounds a little bit weird, but that's a key point here. Market portfolio's risk exposure to the market portfolio is what? Is itself, right? Market portfolio and its risk exposure to the market portfolio is itself. How do you express that? Is beta is equal to 1, right? It's the same risk exposure. Therefore, what's the component for the market portfolio? That's the summary. So a market portfolio includes, let's say, there are 5,000 stocks within the market. So each of the 5,000 would be one element to the market. They have a different betas over there, right? But if I add the different betas all together for the 5,000 stocks, what's the average of that 5,000 betas? Should be 1. Because 5,000 stocks add up, that becomes a market. So that's a market total exposure. Therefore, from this, you should be able to understand why there is a negative over there. Some stock within the market has to be negative beta. Otherwise, the whole market will not be add up equal to 1. Right? So it's the average beta of all stocks listed in US market. If you didn't say this one, we're okay. But empirically, that's the case. But it has to be a relatively long time. Why it has to be a relatively long time? Well, think about this way. If the market, as we said, the market portfolio is equal to 1. However, during the financial crisis, the market could drop significantly. Therefore, we could have a market portfolio which is exposure is negative 2 or 3. That's possible. But in some good times, like before 1996, like before 2005, market performance is very good. So they have a positive beta over there, and it's larger than 1. That's why in the long run, you have the large, you have the number positive and over the 1, you have the number negative, and perhaps it's less than 1. Then you have sum them up, you can get the average number of market beta is equal to 1. Okay? But at the minimal level, you should be able to show anyone on the other table, either the examiner or the interviewer, that a CAPM model should be right in this form. And remember, there are 2 pieces. Risk-free return, it's an expected return, includes risk-free return and plus exposure to the market. And we call the market, we call more scientific name on this is market risk premium, market risk premium. So we would write down this is risk-free return. That's the first part. And the second part, this is exposure. And third part, we call this market risk premium. Okay? 3 pieces. So as long as you can understand these questions for anyone, you can, for anyone ask the questions, either for the exam or in the interview. If they ask the questions about the CAPM, you can answer the question at this level. It should be fine. Okay? So that's the first one. So I have to eliminate anyway. Okay. Feel free to take any pictures or whatever, and then I just have to eliminate this one. Okay. Okay. So I see nobody. Give you 10 more seconds to take the picture. Because I have to eliminate, I cannot save this one. It's floating. It's floating on the glass. It's not embedded in the PDF documents. Okay, so I see no one is taking picture now, so I'm moving on. Okay, so right now this is more about the theoretical part. It's more about the theoretical part. We are lecturing this one in this way is in the academic world, actually we have more rigorous proof for the CAPM model. However, at the MBA level, that's not quite necessary. So we just try to give you the flavor. So the first question is try to answer the question from the theoretical perspective. Okay, so short answer in the future, if you keep moving the academic level to the PhD level, this is actually not sufficient. You need to show some scientific proof, mathematical proof on this model. But right now, this is to give you the flavor that how we argue or prove something from the perspective of academic, which is different from what we're going to use the empirical or numerical example to show something. So we move to the next one, which is we're going to show the CAPM with the numerical example here. Let's look at the second one. Expected return on the market portfolio is 15%, and the return on the risk-free security is 5%. What is the expected return on a portfolio with a beta equal to 0.5? If you, I listed method 1, method 2 here. Method 1 is coming from the textbook. Method 2 is coming from, well, is when I see the question from the perspective of the student, that's the most intuitive way for me to answer this question. So let's start with the method 2, then we go back to the textbook answer method 1 here. Okay? Since we already learned the CAPAN, right? We learned the CAPAN that the model could be written as this format. So the basic answer when you see the next question is we just plug in all these numbers. Okay, so what we're going to do is try to plug in those numbers. That would be our method 2 to answer that. So risk-free assets is 5%, so we just plug in the 5% here. And what is the beta? Beta is 0.5, so this is a beta. And what is market risk premium? Market risk premium is equal to market return minus risk-free return. So that is market risk premium, right? And punch a few calculators keystrokes, you get the 10%, right? That's a pretty, well, this is a pretty mechanic. We follow the formula, but the training lets you understand what exactly for each element the mean in this formula. But right now, textbook provide another way to understand this is from the graph or from the chart. Okay, let me explain this. The beta of the market portfolio is equal to 1. Therefore, we can use the security market line graph to determine the halfway point between the point 1. This is the coordinates. Okay, that's a coordinates, like in the GPS, right? It's 1 and 15%, and another point is 0 and 5 points. We can then average the first and the second value of the two coordinates to arrive at 1 plus 0 divided by 2, and 15% plus 5% divided by 2, right? And then we get, actually this is, that's a typo here. Should be divided by 2. That's a 0.5 and 10%, which means that the expected return of a portfolio with a beta equal to 0.5 is 10%. Okay, how do I understand this? Let me give you a chart here. Okay, this one is expected return. Has to be E, refers to expected return. And the horizontal axis is measurement of risk. So right now I give you a choice. It's a multiple choice question. Okay, actually it's a two choices question. It's in the beta world, sorry, in the CAPAN world or in the security market line world. How do we measure the risk? Choice A is a variance or standard deviation of the portfolio. Choice B, it's the beta to the systematic risk. Which one do you think is correct? B, right? B, yes. So this is the beta. That's the beta. If you're talking about standard deviation, you're talking about variance, that would be push understanding, go back to 1958, Markowitz theory. Okay, we measure the stock return by the mean variance arena. Once we, off the 1964 paper, we're going to understand this as a CAPAN world, the CAPAN world. Okay? And there is a risk-free return. Think about the risk-free return. Think about this is a 5%. Let's say this is 5%. Because it's risk-free. And so what's the coordinates of the risky measure in terms of beta for these 5% risk-free assets? 0. Yeah, that's 0. So that's why I can put it in here. For the market portfolio of 15%, that's a very important question. I want everybody to think it very carefully. It's plotted on the screen is very easy, but to understand why we should plot it on the screen is it's relatively important to understand what is how do we understand the beta, okay? We're going to enhance what we have discussed in the first question in this one. Tell me, a market portfolio of 15%, what is the beta of the market portfolio? I mentioned this question in the very first question. What's the beta of market portfolio? 1. Okay, very nice. You know the answer of 1. Let me be a little bit conservative. You know this one because you remember what I have already told you. Now you have to convince me, tell me why the market portfolio should be equal to 1. Like I said before, it's the risk exposure of the market portfolio to itself. Right? That's a market portfolio itself. So the exposure would be to themselves. That's equal to 1. Therefore, any assets, if we can put into the CAPAN's world, in a world, we should have at least 2 dimensions, right? Think about the GPS. You need 2 dimensions, right? It's the same thing here. And what is the CAPAN's world 2 dimension? Is 1 dimension show what the risk is, and the other dimension show what the return is. So for the market return here is a 15%. The 2 coordinates I'm looking for, the expected return is 5, let's say 10, let's say 15. It's here. So the market portfolio, the coordinates could be any one along this line. How much is the risk? 1. The beta, measured by the beta, right? So beta the risk is 1 here. So we know that that's the point, right? So we eliminate all the rest of them. And we show this is, that's a market portfolio. So that's market. You can see right now, the market portfolio could be considered as a single asset. It's a single asset, right? Because we can measure its return, we can measure its risk exposure. So that's 1. So what we can learn from the security market line is, from this point on, we can draw a correlation, a line between these 2. So the 2 assets, so any combination between the market portfolio and the risk-free portfolio could be find the best way we can find any combination or weighted combination is along this blue line here, along this blue line, right? That's coming from where? Efficient market frontier and CAPAN. It's coming from these 2, right? We already know that. You know that originally we have a curved shape, which is the dominate on the right-hand side. It's impossible on the left-hand side, and that's why we call that line as efficient market, efficient frontier. But then CAPAN comes in and say, no, even if that's the efficient, we can do even better than the efficient market. How do we do that? We add a risk-free assets, then we can achieve that the same combination of the risky assets, we can reduce either reduce the risk, which is on this dimension, or increase the return. So that's where we had the security market line here. Therefore, if a security has the beta of beta of 0.5. So you find a beta 0.5 here. That's your beta of 0.5. And then you want to know what is the expected return. So how going to know? Because right now they told me, here the blue line tells you it's only along the blue line you can find the best combination of the risk return. So your other options here are dominated by the blue line, here. Then the only work you know is you need to find here, which is because that's the best choice you have. That's the best choice you have. And then when you come to on this, you get the 10%. As you can see here, these are two different mechanisms to answer the question. Either way is correct. Okay? For most of the students, the method 2 would be much more straightforward. And I hope that in the future, you're going to use the method 2 in the future for the answer for the questions and to answer for the interview questions in the exam and in the interview. But if you have some time, for the first method, you really need some time, and you really need a piece of paper and a pen to draw the graph to show people here. It costs more time, and you need more organization of your English communications to the people in front of you. So that's, I would say the first method is a little bit risky, but it's going to add more value because you understand, you can explain the campaign in a very pristine way to understand. But this is going to be a little bit risky because if you mess up, people don't understand what you're talking about. Then the better way is you show the method 2. Okay? So that would be the, anyone want have a further question on this one? I'm a little bit slower at this moment because I know that there are some students come to this course as a relatively little background in finance. And I can remember when I was in the first year in the MBA, when I started in the finance course, in our classes, students are coming without a finance background. It's a little bit struggle in the first hand to understand all this. So I try to be slower at this moment. If you don't have any questions, I'm going to keep moving on. Okay? Okay, the third one. Draw the security market line for the case where the market risk premium is 5% and the risk-free rate is 7%. Now, suppose an asset has a beta of -1, and an expected return of 4%. Plot it on your graph. Is this security properly priced? Next, suppose another asset has a beta of 3.0 and an expected return of 20%. Plot it on the graph. Is this security properly priced? Okay. So what we're going to do is we follow the methodology that we have talking about through the capital security market line. And we try to think about think about the third question as a scenario. In the future, you will be on the position to mandate your firm's wealthy and try to hire external fund manager to manage the funds for your company. So those candidate managers will come to you to propose the asset they may select or have already selected. One of the key measures they're going to use is using the beta. Okay? Once we have used the beta, then the next thing we could choose is choose alpha. We talk about this, Jensen's alpha and the beta. But right now, let's talking about the beta at this moment. Therefore, you could understand whether what they are talking about is reasonable or not reasonable. So this question is about how do we describe or judge a security. So right now we're talking about the securities based on risk and return. Whether this security is reasonably priced. Okay, how do we do that? Is think about this. Go back to the question. You have the market risk premium, so tell me what is the market risk premium here? What's the market risk premium? Speak a little bit loud, please. There are two elements, right? Yeah, it's a market return minus risk-free return. So market risk premium is return on the market minus return on the risk-free. That's basically. So that's equal to this, and the risk-free rate is 5%, 7%. So we know that market return should equal to 7 plus 5. That's a market return, right? Because this one is equal to 5, right? So you have the market return is 5% plus 5, 7% plus 5%. That's 12%. Okay? So right now you figure out this. And now you have the beta information. Now the next one is let's go to this one. So we know that we know that through the security market line here, we know that the risk-free rate of return. So I have to shrink this a little bit in order to cover everything up. Is that good enough, or it's too much? Oh, no worry, I can still do that by eliminating this one. Okay, so this is risk-free rate of return, 7%. Market, no. The market risk premium is 5%. And because of the beta, it's -1. So we calculate the expected return of this beta if, be careful, I use emphasize, if the beta is equal to -1, then the expected return is equal to 2%. However, this asset reports it has 4% return. So what could happen? So this is something that my answer is deviate from the textbook. Okay, deviate from the textbook suggested answer. And I believe this is this answer is more conservative. It's more conservative. Okay, I present my answer, and then I'll let you know what the textbook answer is. So that this could point out two directions. The one direction is, and in general, two directions allow us to make the same statement is the return did not match its risk exposure. So I think this is very important. That's my own answer. It's different from the textbook answer. Why? Yes, you think about this. If the measurement of beta is correct, then the return of 2% is lower than the return of 4% suggested by the estimation. Therefore, the return should increase. And usually in the stock market, the return increase is associated with the stock price increase. Therefore, that stock price would appreciate. And that's textbook answer. But a textbook answer, I believe, textbook, that's my own opinion. Textbook answer ignores the second possible scenario. What if your beta estimation is incorrect? Right? If the return of 2% is correct, so that leaves a second, I said the second, I didn't use the word the other, okay? Which means there could be a third one, okay? Leads to a second alternative answer is if the expected return of 2% is correct, then the beta estimation should be updated or modified or revised, right? That's my answer to the second part, right? So whether you want to agree or not agree, that's totally based on you. But I tell you, I think my answer, the second, especially the second one, is much more conservative than the one that's totally ignored in the textbook. Okay? Why? Remember, in the lecture notes, we're talking about beta cannot be observed. Beta can only be estimated. Everything, if you estimate them, then you subject the risk of the estimation could be wrong. So that's my argument on this. If the beta estimation should be updated, which means the beta is not equal to exactly -1, then you have to tell me what is the direction of the beta we're going to move. So in this case, you can solve this one, right? So you have 2% return is equal to, how much is the risk-free return? It's 7% plus the beta, which we don't know. But we know an incorrect answer might be -1 times market risk premium, which is 5%. So you can solve the beta is not equal to -1, right? So that's why I said from -1 to less negative. As I said, this is the second possible answer. So it's more than 1 or less than 1. You can calculate this. Is it more than 1 or less than 1? You do the calculation. How much is the beta here? It's a negative, yes. How much is the number? Oh, sorry. This one is, let's see. Yeah. So in this case, the beta is correct. If the beta is correct, okay. If the beta is correct, so I'm going to update this answer, okay. If the return 4% is correct, then the beta would change. If the beta is correct, then the return would change. Has to be the 2%, right? So in this case, beta is equal to -1. -1, yeah. Okay, so I'll be more precise. I'm going to rewrite this. So that's basically 2 conditions. But there is a third one. So the estimation, so the third one is it's the estimation. So because it's an estimation, we usually in academic, we just use estimate, okay? The estimates of beta and expected return could all be because that's an estimation. Therefore, the return could change and the beta could change at the same time. But all the three different results point out one conclusion which we can make here, which is, that's the conclusion. The return did not match its risk exposure. These two things have to match up in all your future work and in all the workers that come to you. Otherwise, they have to be revised. That's the basic idea. Okay? Any questions on this? Okay. No more questions? Okay, the last one would be relatively the same thing. So you write this line here, and you do the calculation. It's 7% risk-free return. That's routine. 7% market risk, premium 5%. The beta is a new thing, 3. And you calculate this one is 20. But this one is not equal to the 20%. Therefore, we have 3 different answers. So it's either the return could increase from 20% to 22%. This is suggested by the textbook. But in the other way, beta could, if in that way beta is correct, return is wrong. And if return is correct, the beta has to be adjusted. And there is a third possibility, is the beta and the return should also be adjusted at the same time. That's basically what I want to say here. Any questions? Okay, we can take a break. And when we come back, we can Okay, let's get started. Today we're going to start a discussion on a new topic. It's cost of capital. As we discussed this before, there are a few points here. I'm going to save this one, and everybody can see this on the updated lecture notes. We start from a simple balance sheet. Current assets. On the asset side, we have current assets. We have a property, plant, equipment, and other asset class. On the other side of the balance sheet, we have two items in general. One is liability, the other one is shareholder equity. Liabilities usually we start with debt, and including that we have more different subcategories such as bond, bank loans, line of credit, commercial paper. All these could be debt, which belong to the large category of liability. In terms of equity, we can have common equity. We can have preferred equity, preferred shares. But the question here is, we want to measure the cost of capital. How do we define or understanding the cost of capital? So the first understanding of the cost of capital coming from the opportunity return, cost of return. So how to understand that? It's the return that the firm's investors could expect it to earn if they invested in securities with comparable degrees of risk. Therefore, the cost of capital is the rate of return required by the providers of the capital in exchange for foregoing an opportunity to invest in alternative projects with a similar risk. Therefore, it is known as the opportunity risk, opportunity cost. So what does this say is the cost of capital is the cost that could be invested in another object instead of asset of the firm that is able to bring up with a similar risk level. Okay? To further understand the cost of capital in the bigger framework of corporate operation, firm operation, then we need to bring another two elements into consideration. The first one is investment decision. One of the major motives for the corporate to move forward to increase the stock price is because the corporate could earn more revenues. In order to earn more revenues, there are different methodologies. One of the methodologies, you need to invest in new technology. You need to invest in new plants. And in another word, you need to have the economy scale or economy of scope, both of which requires investment decision. And when you value the investment decision, in the very first time, we know that's NPV IRR, NPV by IRR. But then when we come to the cost of capital, we need to compare that NPV and IRR with the cost of capital of the firm, which is opportunity cost of investment. You need to compare this. Why? Because all the investment decisions are based on whether a project could bring to the firm with higher cash income or higher cash flow. And when you go into the investment decision, another consideration that you may want to have is, what if the financing of the firm is not fully equity financed, which means you need to borrow something from external without give them control rights. debt is kind of liability that fulfilled in this category. If you want to borrow from external finance, then you need to make the decision whether the external financing is worth the cost. Again, you need to consider any new project that you want to invest in, how much is the required cost of capital, and if you want to finance that decision by the external borrowing, you want to compare how much is the cost, so you can make the decision. So that's why that cost of capital has been in the central of the pivotal corporate investment, corporate finance. Managers cannot observe the true cost of capital. This is like the CAPM. They cannot observe the true cost of capital. They can only estimate it using the theory and the tools of modern finance. A firm can be seen as a portfolio of resources of finance, including both debt and equity, used to fund a portfolio of assets. Therefore, the cost of capital is the weighted average of returns, which is defined as weighted by market value, on both debt and the equity. Now, the first question here is, think about a geothermal corporation has total market value of 647 million, market value for the firm's assets, and of which the 647 million, 194 million is debt, and the rest, 453 million, is equity. Given that geothermal pays 8% for the debt and 14% for the equity, what is the company's cost of capital if there is no corporate tax rate? And what if the corporate tax rate is 35%, what the cost of capital would be? To calculate this question, we need to follow the next formula, which is how to calculate weighted average of cost of capital. In short, this is referred to as WACC, weighted average cost of capital. There are 3 steps to do the calculation. First, we calculate the value of each security as a proportion of the firm market value. And in the second step, we try to determine the required rate of return on each security. And on the third one, we just calculate a weighted average of these required returns. Let's start it with a very simple case without corporate tax. Okay, so I need to go back because I don't know why this one didn't show up. Okay. So if there is no corporate tax, the weighted average cost of capital would be equal to the two pieces. The first piece is we have the RD here. RD referred to cost of debt, and the RD times another fraction or weighted the debt weighting. So debt weighting is calculated by D over V, capital V. The D is the market value of debt, and the E is market value of equity. So V is equal to, let's further be precise here. So V, V is equal to D plus E. Okay, let's see if I go back, whether it's still, okay, go back is still there. So V is equal to D plus E, and I have to mark, because in the later on, we have in this textbook, and its associated solution, the debt it uses is market value of that. Market value of that. Okay? But in all the academic paper that I have read so far, we all use book value of that. So I have to tell you is there is another way that is equal to book value of that. Okay? This one, book value of that is much more popular in all the academic paper. Academic paper is firm value is defined as book value of that plus market value of equity. That's nobody's question about that. But this textbook say it's a market value of that. So I want the students know that to answer the question in the exam, to answer the question in the solution, in the tutorial question, we follow the textbook to use the market value of that. But I want you to remember, in the academic paper, firm value is equal to market value of equity plus book value of debt. Later on, when we have the example, later on. I'm going to tell you why the logic is more consistent with book value of debt instead of market value of debt. Okay? What if there is a corporate tax rate? So if there is a corporate tax rate, then we have to calculate in the tax shield. And TC, let's see, TC is the corporate tax rate. Therefore, after the corporate, with the tax rate, we have the tax shield. Then the tax shield part is 1 minus the TC. Taxes are an important consideration in companies' cost of capital because its interest rate payments are deducted from the income before the tax is calculated. So that's a reason we need to use 1 minus TC to generate weighted average cost of capital. Now with those formulas, we could answer the question we raised a few minutes ago. Let's review the question again. Geothermal incorporation total value of the firm is 647 million, in which 194 million is debt and 453 million is equity. Given that geothermal pays 8% of debt and 14% of equity, what is the company cost of capital if there is no corporate tax and if the tax rate is 35%? So the solution for the first one is if there is no corporate tax rate, we'll follow the first solution over there. We don't need to consider any tax rate. It just tax weighted average. It's a cost of debt, which is 8%. And there is a 194 million of debt in the, it's a proportion of 647 million, and plus the second piece, which is coming from equity. The cost of equity is 14% times the proportion of the equity within the assets, which is 453 over 647. That's the first part, without corporate tax. And if there is a corporate tax, therefore the borrowing of the debt with the interest rate payment could be deducted from the tax calculation. That's why we need to add another piece to calculate the cost of debt, which is 1 minus the corporate rate, tax rate, 1 minus 0.35. Therefore, we're going to copy the same formula as we did without corporate tax, and then times a third piece, 1 minus 35% into the elements calculating the weighted average cost of debt. Then we can get weighted average cost of capital. Any questions so far? Now we have a bunch of examples based on the formula that we have. We have a bunch of examples, large corporations, that we could calculate what exactly is the weighted average of capital, as we can see here in this column. This is the highlight here is weighted average cost of weighted average cost of capital. That's the calculation here. As you can see here, for the large corporations, the weighted average cost of capital of the firm, this is not for the equity, not for the equity, not for the debt alone. It's the weighted average cost of capital, varies from at least for 4.5%. This is the lowest one I can see here. The highest one would be, let's say, Amazon. So the Amazon will be the highest one, 19.3. The lowest one would be, is this IBM or Walmart? This is a Walmart, I guess. The Walmart is 4.5. In this case, we have expected return of capital, which is in the first column. We have interest rate on debt, second column. Proportion of equity, which is the third column, and proportion of debt, the fourth column. Market capitalization, which is market capitalization, as you can see here. Pay attention here. Did you see that? D, especially, this is the book value of debt. Did you see that? This is consistent with what I described here. It's in all the academic paper, we always calculate that as a book value, not by the market value. Later on, I can explain why we don't use market value of debt, but we could use market value of equity. Why? Because the market value of equity, the formula is equal to market value of equity. So market value of equity is equal to stock price, PRC, that's price, times share outstanding. Okay, that's market value of that. For the book value of, let's see, how do we calculate the market value of debt? That's very difficult. Why? Because many debt, when I say many debt, which means about 30% to 50%, and sometimes even including to 60%, are very infrequently traded in the market. They're not traded at all. Why? A lot of mutual funds take the buy and hold strategy. That's why the fixed income, the bond has another name as a fixed income, because the income is fixed. The mutual fund manager just need the fixed income. So when they purchase the bond, they don't trade. If there's a no trade, you don't have the counterparty as the stock price. Because you have the stock price traded in the market, you have the market price. But if the bond is not traded, you don't have that price. You don't know what the market value is. So that's why in all the academic paper, we don't use the market value of debt. We use the book value of debt. Okay, as you can see here, that would be one. Let me erase this one and put this one. So I can save this one. For the student to use, market value of equity. Okay? So we go back. The next question is, what if the firm has preferred stocks? If it has preferred stocks, it's pretty straightforward, and we just need to calculate the value of the firm in this case. Let me put this way again. Is we need to understand the value of the firm. So the value of the firm is equal to that plus preferred stock plus ordinary stock. I believe this is the notation used in the textbook. Okay? So this is the notation used in the textbook. So value of the firm is equal to that plus preferred stock plus ordinary stock. Okay? So we follow this part. We only need to add in is P, which is the preferred stock, over the V, which is the value of the firm, times the cost of preferred stock. So that's one. Okay, someone may wonder why I should put the preferred stock, that the different one, different than the it's different from the stock, and it's also different from the debt. I can explain that later on, but let's take a look at another example here. Executive Fruit has issued debt, preferred stock, and common stock. The market value of this security are 4 million, 2 million, 6 million respectively. The required returns are 6%, 12%, and 18% respectively. Suppose the corporate tax rate is 35%. What is the firm weighted average of cost of capital? As you can see here, weighted average cost of capital, including all three parts. So for the debt part, we have a 4 million, and its proportion in the firm value is 4 divided by 12 times the tax shield, which is 1 minus 35%. And then the results times 6%, which is the required return or cost of debt for Executive Fruit. But that's the first piece. There are two more pieces. One piece is coming from the preferred stock, and the other piece is coming from the common stock. So for the preferred stock, we have the proportion of the preferred stock within the firm value. So that's 2 million over 12 million times the cost of preferred stock, which is equal to 12%. And that's our second piece. And we have the last piece, which is common stock. So common stock has a value of 6 million, and its proportion in the firm value is 6 over 12. And its cost of capital for the common stock is 18%. Therefore, the weighted cost of capital for the Executive Fruit, which including 3 pieces of security here, debt, preferred stock, and common stock, is equal to the summary of the 3 pieces. Okay, so that's the solution for the example 2. Just try to, as long as I put the solution here, I don't need to put the answer. That's fine for everyone, right? I guess that's pretty. Now the question here is we try to understand, since we know how to calculate the weighted average cost of capital, now let's think about what kind of factors could affect weighted cost of capital. So when we use the word affect, which means we could refer that affecting is coming from the positive side or it's coming from the negative side. So there are, in the textbook, it generally has the 4 different factors. First of all, there could be general economic conditions. For example, There could be a different demand and supply of the capital in the economy, so that could affect the cost of capital. If the demand is larger than the supply, what do you think the cost of capital will go? Is going up or going down? You have a high demand on the capital, then it could be supplied. Would the cost of capital go up or going down? Go up, right? That's normal. Okay, you have same demand of the capital, same demand and supply of the capital in the economy. However, the inflation would go up. Do you think the cost of capital will go up or go down? Go up, yes. There is a second factor is market condition, is marketability of the firm's security. So what is the marketability of firm security is the easiness. Easiness. How easy. Say a stock can be sold. What exactly? How do we sell stocks? IPO. Okay. If it's very easy to sell the stock in the market, which means, for example, during the IPO, so you can sell the stock price with a relatively low price. Therefore, your your cost of equity could relatively be low. But if you need a lot of effort to sell the stocks, therefore your cost of equity could relatively be high. So that's another decision, right? A factor. There's a third factor here. It's the firm's operation decision. The firm operation decision refers to the business risk, whether an operation decision is profitable. How do I understand this? Think about this, is whether the business model could make a long-term profit in the future. Okay, so how to think about this? You think about the Microsoft companies. Recently, Microsoft company has made a huge change of their business model. It is what? It is provide Windows 10 almost free of charge. They give you 1 year period, free of charge. For Windows 8, Windows 7, free upgrade to Windows 10. And that concluded in July 29th, 2016. That's worldwide. Okay? Why they want to do that? After that and before that, they usually charge at least $100 for a new Windows version, Windows 10. They should charge you $100 for that. Why they want to do that? Because they want to change the business model to sell that Microsoft Windows and Office by the different year version. They want to what? They want to keep the cash flow constant. How do they keep the cash flow constant? They're asking you to subscribe to their Microsoft Office. Did you see that? Microsoft 365 is right now it's a subscription version. There is no, there is 2 versions right now, but I still prefer the old one. It's like I have Office 2007, I have Office 2010, 2013, and 2016. So each 3 years there is a version over there. Microsoft don't like that. Microsoft want to use what? Microsoft want to use change to you subscribe, you pay $25 per year. You don't need to worry about further upgrade. Why is it? Because the Google provide spreadsheets, the Google documentations, which provide a similar function. So there's competition over there. So once originally I don't have choice, I have to use Microsoft Office. Right now there's a Google version. If I switch to Google, then I don't buy the Microsoft. That's going to hurt the Microsoft future cash flow. So they prepare for the competition. So they change the business model, which is in here, is the business risk and operation risk. So this is another example I'm going to show you is that think the Microsoft case. Case of Microsoft. Okay? The other one, perhaps the last one that mentioned in the textbook is a financing decision. Financing decision is much more straightforward. It's about the financial risk, whether the debt borrowing is too high. If the debt borrowing is too high, even if right now we have not discussed this issue at this moment, we're going to be talking about the default risk. If you borrow too much, then you have to pay the interest rate later on. Okay, you feel very happy when you borrow because all the cash come in one day. Then from next period, next 6 months, you have to pay the interest rate, and that interest rate will go to lost for the time as the debt before its maturity. If it is a 5-year debt, you need to pay 10 interest rate payments, right? So that's going to be a few factors mentioned in the textbook about how they can change the cost of capital of the firm. However, I want everyone to think about they could be more than that, okay? But for the purpose of education, I think the 4 factors is enough for everyone to consider. Now, let's start with the first elements of cost of capital, which is coming from debt side, on the debt side. So cost of the bond. How do we define the cost of bond? Or have we learned the cost of bond before? Yes, we have already learned that. Cost of bond is just the discount rate of the bond. Okay? How do we know that discount rate of the bond? Well, we have learned that in a long time ago when we learned the price of the bond. So what exactly is the price of the bond? Okay, so everyone don't look at the formula. Or if you have you can look at the formula. Please let me know in your own words, to describe this formula in mathematical terms with just a simple English. It's a simple English. What exactly is the price of bond? Or present value of bond? Okay, so this is how when I teach my other students over there is, let me see, this is my answer. Whether you see this, if you have an even more efficient one, let me know. Okay? If it is not, this answer could offer to you. In the future, you can remember during the interview, you can say something like this. So the price of the present value of the bond or price of the bond is a few keywords here you need to remember. It's a summary of discounted future cash flows. Use the plural. Okay? So that's going to summarize. Those keywords is able to summarize, sufficient to summarize the mathematical expression here. It's, as you can see here, summarized. It's summarized, discounted. How do we discount it? Those are discounted. That's the second one, right? Future has to be future. And cash flows as a plural. Okay? It's a summarized, discounted future cash flow. So you're including all 3 elements. This is the first one, summarized. The second one, discounted. And third one, future cash flows. So you write something like this, you're able to tell people you don't need a pen and write all this, right? So, and the discounted factor or discounted interest rate would be the cost of debt, okay? So RB here is that's our cost of debt. That's our cost of debt. Cost of bond, sorry, cost of bond. Okay? Okay, let's move on. We know that corporate debt exists at least more than one form. One form, we can have the debt, corporate bond market in the market. So that's how we price the bond. But in the other end, we have the bank loans. And the cost of bank loans is simplified as the interest rate charged by the banker. Therefore, if we have more than one debt issues with different cost of interest rate, therefore overall cost of debt is just the weighted average cost of individual debt issues. So that would be the next formula here. Any questions so far? Okay. Now here's another question here. Is to invest in a new project, ABC company just raised 45 million of debt from multiple resources. The firm issued 25 million of public debt with yield to maturity of 8%. It also borrowed 20 million from the bank, in which 50 million is secured loan with interest rate 6%, and 5 million is unsecured loan with interest rate of 9%. What is the firm cost of debt financing? Okay, without further referring to the question here, I may ask you one question that is associated with the question itself. Based on you have learned so far, give me a reason, you have to based on what you have learned so far. Why the security loan charged the interest rate of 6% and the unsecured loan would charge the interest rate of 9%? High risk, yes, that's very nice. Okay, you can answer it's riskier, higher risk, more uncertainty, not secure. Once you have all these answers, either one of these answers, the people sit on the other side of the table understand what you understand about this. And you don't have to learn what is exactly of security loan versus unsecured loan, but you're coming from the interest charged difference. You can refer or can infer how much the risk, comparative risk is. That's very nice, okay? So we just follow the formula here. 45 would be total debt, of which 25 would be public debt, 15 would be security loan, and 5 would be unsecured loan. And we just need weighted average of the cost of debt. In each case, we can get RD, which is the cost of debt. Once we finish the cost of debt, next piece we have to value is cost of equity. Let's start with the common equity. Okay? To evaluate the cost of equity, we have two methods. The first method is to think about the cost of debt is equal to the expected return of the single assets. What exactly is this single assets? The firm asset is considered as a single assets. Therefore, you can run that the firm, which we know the equity price is the stock price through the CAPM model. Okay? So how do we do that? Is the expected return, or I, is the expected return of the stock, and RF, a risk-free rate, beta systemic risk, and RM is expected return of the market portfolio. Therefore, the cost of capital, which is equal to, that's our cost of equity, the other name, or common stock, that's equal to the cost of equity, right? So that's one way. There is a second way. We have learned this pricing the stock price from the dividend growth model. So the dividend model could have two different versions. One is the dividend discount model could have a constant growth dividend model. We have a no constant growth dividend model. And if it is a constant growth dividend model, we know that what's the dividend paid to be paid in the next stage, which is t equal to 1. And we divide it by the dividend growth, the dividend payment by the required return of the ordinary share or discount rate for this common share, and minus the constant growth rate of the dividend. In the special case, the growth rate could be equal to 0. So we have a constant dividend. Okay? Therefore, that the capital R here is our other estimation of required return. In other words, this is cost of equity. Cost of equity. Okay? Any questions here? What about if the dividend growth is not very constant? Think about this. They have irregular dividend at a different time period from D1 all the way to DT here. And after DT, the dividend become constant, right? And then that becomes a PT. Therefore, we can use this formula that we learned before, that the PT would be market price of the stock at a time T, and the D is a dividend payment at each different period, and then the R here is the same as we discussed before. That would be cost of equity. Any questions here? Okay. Once we finish the common equity, now we have another third class, which is cost of preferred stock or preference shares, which is mentioned in this. The terminology of preference shares is used in this textbook. North America, we usually use preferred stock, okay? So I'm going to write here, or preferred stock, okay? Preference shares are a form of equity that has a stated value and a specific dividend rate. So that's why, remember, we asked the question in early slides. When we have the preferred stock, and we didn't put the preferred stock either in the category of debt or in the category of equity or common shares. So we asked that question. Now it's the time to answer the question why we don't put them into either of the equity category or in the category of debt. That's because they have some similarities with either debt or common equity, but the major here is there is a difference. Unlike that, preferred stock stockholders receive a specified dividend in perpetuity. Unless the company repurchases those stocks or goes out of business. So what does that mean? The key word here is perpetuity. And it's specified dividend. Okay? Think about the debt. Debt, once it's issued, there's a maturity over there. And the debt financing interest rate could change over time. Okay? For example, the firm issue a 5-year debt. The interest rate is 5%. After the 5 years, interest rate going down. So the firm don't need to pay 5% for another financing. So the firm issue another 5-year debt. Interest rate could be 3%. You can see that from 5% drop to 3% in 10 years. But if it's a preferred stock, and preferred stock say that the dividend is going to be paid on 3%, and that has to be forever, preferred stock. Then the company were going to pay 3% when the corporate debt is at a 5% level, and we're going to keep paying the dividend of 3% when the external financing of this firm drop from 5% to 3% level. You cannot change this. And if you want to change, the firm want to change this, there is a way to change that. It's either you repurchase those preferred stocks. After the repurchase, you don't need to pay the dividend anymore. But the other thing is, the firm go out of business, went bankruptcy. Therefore, you don't have the resources to pay any dividend. That's a difference from the debt. There is another difference from the equity. So preferred stock is kind of stock, equity. But it's not that common stock or common share. And preferred stock, different from common share or common equity in the major part is by the voting rights. So what exactly is voting rights? It's for the corporate control. If the shareholder don't like the current management, they could use the voting rights to drive the current management out of the company. Okay? Basically, they're going to fire the CEO or the board of the director. Okay? There's another difference here, is if the firm is unlucky and go out of business, for example, filing for bankruptcy, the preferred stock would have the higher priority to take their money, to take their investment back than the common shares. Okay, so that's a second difference here. So how to value the share value of the preferred stock? And we know that because the preferred stock is paid the dividend forever. So we could use the same formula as perpetuity security, just the dividend divided by the return or the discount rate for this dividend. So that's RP here. So RP is equal to the DS. DPS is dividend, market price of the preferred, the dividend of the preferred shares. And PPS is the market value of the preferred shares. Any questions? Okay. So let's, there is a slightly complicated example here, and let's describe the question or the example, then we'll take a break. After the break, we'll keep going on this one. A mining company has 3 types of debt. Also has preferred shares and ordinary shares. For the debt, it's 4 million secured bank loan with the interest rate of 5%, 3 million unsecured loan with interest rate of 7%, and a 0 coupon bond will expire within 1 year, with a market value of 0.95 and a face value of 1 million. There is preferred shares here. There are 20,000 preferred shares outstanding, and the current market price per share is $100, with an annual dividend payment of $10 per share. There is another third class of ordinary shares. It has 1 million ordinary shares outstanding, with a market price per share is $20 per share, with a market price of $20 per share. That's more, sounds more correct. The beta of the stock is 0.9. The current risk-free rate is 4%, and the return on the market portfolio is 14%. Suppose the corporate tax rate is 35%, calculate weighted average cost of capital of the company. Okay, so that's the question. Let's take a few minutes break, about 7 minutes, let's say. When we come back, we're going to work out how to solve this question. Okay? Okay, let's get started. So we have three major categories of financing: by debt, by preferred shares, and ordinary shares. What makes this question a little bit complicated is within the category of debt, there are three subcategories. We have the bank loan, secured bank loan, we have unsecured bank loan, and in addition, we have a zero coupon bond. So how to measure this? We're going to follow just the formula that we discussed before. So the solutions generally follow the following formula. Its weighted average cost of capital of the firm is equal to the cost of debt with tax shield. And that's the first piece. And then the second piece is preferred stock, and third piece is ordinary stock. Okay? So the cost of debt, let's pay a little bit of attention on this one. RD, cost of debt. And how do we calculate RD? Remember, the cost of debt is equal to the total value of debt. So the total value of debt, how we calculate them, is, if we go back, we follow the textbook solution here. 4 million secured bank loan, 3 million unsecured bank loan, and 0.95 the market value of the bond. But this is the textbook provided solution. But have you noticed that there is a logic inconsistent here? The calculator provided by the textbook has a logic inconsistency here. Can you find it out? Where is the inconsistency come from? Okay, you notice that market value is 0.95, right? They specifically mentioned this is a market value of 0.95. What exactly is the market value? This is current value. Because this is the zero bond could be sold in the market. And that's how we calculate the zero coupon bond price. That's how we calculate what the discount price is. However, when we're talking about the 4 million secured bank loan, 3 million unsecured bank loan, this is the face value or the book value. The 3 million bank loan, and if the interest rate is 5%, and if the maturity of the bank loan is 1 year, and the market value of this bank loan would be totally different if the bank loan has a 5-year maturity or 3-year maturity. You see that? The 4 million bank loan, 3 million unsecured bank loan, they are face value or book value. Their market value could be, and in this case should be, much more different from 4 million and 3 million. Therefore, you cannot summarize the future value and the present value altogether. Okay? You don't need to criticize the textbook. What I'm trying to tell you here is calculating in this way is inconsistent. Okay? What could be consistent is, I mentioned it in the next one, in the page. It's a textbook, 470 pages. Use the market value of the debt to calculate the debt D here. Okay? What I would suggest in the future, is we follow academic literature here. We use, so to be more conservative, I use the word alternative. And I mentioned this alternative is much more popular in academic research paper because they use the book value of the debt. So if you use book value of the debt, that would be equal to 3 million plus 4 million plus 1 million, zero bound here. Okay? That's much more consistent in terms of logic. Okay? You use this one, use the market value of the debt to calculate everything during the exam, no problem. We're going to, but you ask you is, what I'm emphasize here, you should be able to at least remember there is another way which is quite popular in the profession, which is using book value of the debt. Okay? And then we have here, if we look at this very carefully, so we have 4 million is, so the cost of the total debt is 3 plus 4 plus 0.95, follow the textbook. So 7.95, of which the 4 million is secured bank loan, whose interest rate is 5%. That's the first piece. Second piece, 3 million of unsecured bank loan, and its proportion within the 7.95 million, and with its cost of unsecured loan as 7%. That's the second contribution. And the third contribution is 0.95. That's the market value of the zero coupon bond, and its proportion and 7.95 million. And then we need to find out what is the cost of zero coupon bond, which is the rate of the zero rate. And how do we calculate the zero rate? Is face value is 1 million, right? Present value, market value 95, 0.95. And one face value divided by, and you write this the other way. I'll write this way. So the 0.95 million is equal to 1 million's face value divided by R 0 plus 1, because that's a 1 year. So that's how we calculate the present value of the zero coupon bond, right? And then we do some manipulation, then we can get this one, the zero rate, right? Okay. And then once we solve out this, it's pretty much very straightforward. We just plug in the number, cost of preferred shares, cost of ordinary shares, and we just plug into the number, and we can get the results. We have the current price of the share, the dividend divided by, how do we calculate that? For example, how do we calculate this one? It's a dividend divided by its current price. That's the cost of, it's a dividend divided by, do you need me to write here? The cost of preferred share is a $10 dividend divided by $100 price. Would that be necessary, or I think everyone can get this one? And for the cost of, let me write this anyway, okay? So it would be so that is equal to DIVID dividend divided by current PS preferred stock price, right? Okay, I'm going to remove this one, and for this one, cost of ordinary shares, how do we do that? We have stock beta here, we have current risk-free rate, we have a return on the market portfolio. Then the very easy way is equal to risk-free rate plus beta times market risk premium, right? So that's a That's how we get the expected return or cost of capital from ordinary capital, right? So I'm going to make this one a little bit more right here without, the zero rate is 0.95 is equal to 1 divided by R0 plus 1, right? That's how I get the zero rate. And then we have all these dividend current price, right? So should we provide a sufficient solution here? Okay. Any questions? Oh, yeah, by the way, any questions on this part? Any further explanation you may need? Any questions? I want everybody happy on this one. Because all the way, in terms of calculation, that's so far probably most complicated. Once you iron out any of the wrinkle on this, more or less you are in good shape. In good shape to understand what's the firm value, cost of capital. So why this is important? Because the next week, not next week, it's next week you have a midterm, you have another lecture on financing, and after next week we're going to discuss a very, very important theory in corporate finance. It's called Modigliani-Miller theory, MM theory. So that's a very, very important theory in corporate finance. And we're going to use the cost of capital, weighted average cost of capital of the firm. Okay, how do we value of the firm? Value of the firm by cash flow, by dividend, and weighted average cost of capital. Okay, we're talking about the leveraged firm, unleveraged firm. So if you don't understand the weighted average cost of capital, of course you're going to have problem when we discuss about the Modigliani-Miller theory. So that's why I suggest the students, if you have a problem with NPV IRR, you should come to the lecture in an early stage, as early as possible. Don't accumulate these questions until when you go to the quiz, you find, oh, I don't know how to do this. And then that's the problem. And you need to sort it out as early as possible. So I want everybody happy with this calculation, with understanding of weighted average cost of capital here. It's a combination we're talking about in the firm level. And at the firm level, we could have equity, we could have debt. Within the equity, we could have ordinary equity, we could have preferred equity. Ordinary equity and preferred equity, they could have different cost of equity. Why? Because the dividend they pay are different. The present value of the price of the dividend preferred stock and ordinary stock would also be different. Therefore, the weighted average, their cost of preferred stock would be different from cost of common stock. That's the first one. In another piece, in terms of the debt, the cost of debt could be very different from cost of equity, right? But within the cost of debt, there are different subcategories. You can have bank loans, and within the bank loans, you can have secured and unsecured. And in the future, if you keep learning in this direction, I'm going to tell you there are at least 2 other subcategories in the debt. We know there are bonds, right? Its maturity longer than 1 year, we call this a bond. What if the maturity is shorter than 1 year? Zero bond. You understand this is zero bond. But do you know there is a commercial paper? Yeah? We know there is a secured bank loans. What about the revolving line of credit? That's another one. What is a revolving line of credit? I'm not sure how many of you have, as a student, have a credit card here. How many of you have a credit card? I see quite a few. So when you have the credit card, the bank will give you the credit line over there, right? It's how much money you can borrow from the bank. So the revolving line of credit is kind of a credit card bank issued for a firm. It's a credit card, basically. And that's short term as well. Okay? So what we can find here is weighted average cost of capital of the firm, you have to understand, is in the aggregate level, including different financing resources in two major categories of equity and debt. Okay, you understand this? That's a foundation for us to moving forward for the next very important theory in the Modigliani-Miller theory. That's very, very important. Okay, so I want everybody to be happy with the calculation so far. Everybody, not just sitting in the classroom because it's recorded. The student can read this in there. So the purpose to calculate the weighted average cost of capital is we could use to evaluate either the firm or the stock. We estimate the firm cash flows. We discount the cash flow, use weighted average cost of capital, so we can arrive what the firm value is. Then once we subtract the debt from the firm value, we can get what the stock value is. We can also use the weighted average cost of capital to evaluate a new project. So use weighted average cost of capital to evaluate the project. There are two conditions. The company's weighted average cost of capital should be used to evaluate the cash flows for a new project only if the level of systematic risk for the project is the same as that for the portfolio of the project that currently comprise the company. The second condition is the company weighted average cost of capital should be used to evaluate the project only if the project uses the same financing mix. It's the same portfolio of the debt, preferred shares or ordinary shares used to finance the company as a whole. Unfortunately, this is not exactly true for some of the individual projects. So if the weighted average cost of capital is higher than the true discount rate of a project, you may wrongly reject this project. On the other hand, if the weighted average is lower than the true discount rate of a project, you may wrongly accept the project. So what exactly this two is about? How many of you know that a type 1 error and type 2 error? It's statistics. I heard something sort about that, right? So what is this exactly about? Can you tell this one, use your own language? Regarding, forget about which one is type 1, which one is type 2, but you have to tell me what's the difference between type 1 and type 2. I reject what? Okay, it's very nice. See, that's kind of a logic we put in here. You reject something when it is true, right? Then you accept something when it is actually false. So that's one between type 1 and type 2 error. So this is the same thing here, okay? So when we use the weighted average cost of capital to decide whether we should accept or reject a project, we need to compare that weighted average cost of capital with certain threshold. That's what we're talking about. There's a threshold or benchmark we need to compare. Okay, suppose the true discount rate of a project is equal to, let's say, 5%. It's 5%. However, the weighted average cost of capital here is 8%. 8%. Let's write this up. Let's write this up. Okay? Let's write this up. Let's say true discount rate of the project is 5%. Okay? And the weighted average cost of capital is 8%. So someone, not you, based on that 8% of weighted average cost of capital and reject the project with the possible return of 5%. And we make the conclusion that reject is incorrect. You may wrongly reject the project. Then, if this is the situation you have, tell me what is possible wrong here. Why the rejection could be possibly wrong. Based on the number, it is not wrong. It is correct. Weighted average cost of capital is 8%. And this project can only earn the company 5%. What is wrong? You reject. Okay, I like that answer. Keep going on. How to value what? Okay, I like that way to thinking. Okay, I like the way that thinking, but for the efficient of a classroom flow, let me talk about this. We have to make sure, as long as we use weighted average cost of capital, it's what? I emphasized very much in the previous slides when we do the example, firm level. It's a firm level. Weighted average cost of capital is a firm level equal to. So firm level, they have a different financing. Equity, preferred equity. In that, we have a bank loan, secured bank loan. We have unsecured bank loan. We have a zero coupon bond. As we know before, if you flip the lecture notes, secured bank loan asks for 5% interest rate. Unsecured bank loan asks for 7%. Corporate bond asks for 10%. You can see that the cost of financing is very different. It's very different. And if the project, the discount rate of this project is equal to 5%, we have to make sure that our decision whether to reject or accept this project is based on where does the financing come from. Okay? If the financing of the project is coming from a bank loan, suppose if bank loan, interest rate is equal to 3%. Can we reject this one, or should we accept this one? We should accept this one, right? We should accept this one. Because the discount rate of the project means that the project could bring that interest rate at 5% per year, but I only need to pay 3% for the bank loan to finance this project. In this case, we need to accept it, but we reject it based on the firm level weighted average cost of capital of 8% is without any foundation. That's the key point here about this one. Everybody get this? Did everybody get this? Let me know if you have any hesitations. We're going to give you a more example later on. Let me know if you have any hesitation on this. We should compare cost of financing for individual project with the possible cash inflow in terms of measured by the discount rate for this project. You should compare, basically you should compare apple with apple. You cannot compare orange with apple. That's the basic idea here. Okay? I see many nod ahead. Now we can see the next one. If the weighted average is lower than true discount rate, and in the first reflection is we're going to accept this one. Why? Because firm weighted average is lower than the discount rate. Why can't I accept this one? Think about another thing. Same 80% here, the discount rate, let's see, is 10%. Same 80% here. Should we accept this one? Project? You should not. At least without considering what is the source of financing for this project. Let me give you a possible answer to this. What if this project is financed by project financed by bond with IR interest rate equal to 12%. The project is financed with a bond issuance, and the bond issuance asks for much higher interest rate, and this interest rate is 12%. You can think any number higher than 10%. And in this case, this project should not be accepted, even if the project itself generates a discount rate at 10%, which is much higher than the firm level weighted average cost of capital, 8%. So that's what another example that you may wrongly reject the project or you may wrongly accept the project, right? Everybody's happy here? No question? Because the next one I have, in the next few slides, we have a similar more example on this. But I want to answer, I want the people happy on this and we can move on. Okay. So the one way to solve the problem is to use the project financing and use the cost of financing at individual projects rather than the firm weighted average cost of capital. That's exactly what we discussed in the previous slides. Okay, so what are the possible examples? Now we have the examples. Okay, let me go back. Let me get into the other one so I can write on this. Okay, so in your slides, I put the question mark here. Now I need to update those. Okay, Easygoing Limited has a new project in sight. New printing equipment costs 1.2 million and could earn 14% IRR as the company could expand its business in metropolitan Melbourne. Cost of equity is 18%, but the Glen Bank is willing to lend the money at 12%. The management decided to use 100 borrowed funds. Shall the firm take this project or shall the firm reject this project? Okay, how to make the decision? We know that whether we should, think about this, before we're talking about a weighted average cost of capital, what's the condition we're going to accept or reject a project? Either IRR or NPV, right? But right now we push this understanding, the hurdle, a little bit higher. Not just the IRR or NPV is positive, but right now we need to push the hurdle of financing versus income. How much you need to pay for the borrowing for this printer and how much you can earn by using the printer for business. That's a basic idea. Okay, so what's the IRR for this project? So the IRR here is revenue, it's the revenue income IRR. So the revenue income IRR of this project is how much? How much? 14, right? When you know something, you should speak out very, it's a 14%. What exactly is the cost of financing for this 1.2 million printer? 12, okay? So because the bank is willing to lend the money of 1.2 million at a 12% interest rate, therefore, it's very easy to make the decision whether you should accept this project or reject the project. So the conclusion is not shout, okay? So this is a shout in the internet. So we keep calm, accept, right? This is accept. Okay. What about the next one? There's another one. Next year, it's the same company. The management of EasyGo Limited identify another project with a cost of 1 million. Its IRR, again, this is a revenue generating IRR, is 70%. And the 70% compared to the previous project is, the previous, they're only 14%. Right now, the management identify another project could generate 70% of interest rate, of income revenue, which is 3% better than the first project. Their approach to the Gleam Bank this time, but the bank is unwilling to lend again to Easygoing Limited. Then what's the other option left for the management is to issue equity, but right now the cost of issuing equity is 18%. Should the firm take this project, or should the firm reject this project? Reject. See, right now when you say something like this, I'm very happy that you fully understand of the lecture content of this lecture. So I have no problem on that. I just put on this, just for the case of the student that didn't attend this one, is revenue generating. That's revenue generating IRR of this project is 17%. And what's the cost of financing for this project is 18%. Therefore, our conclusion is reject. Right? Okay, so I would say this is pretty much that what we want to say, but to wrap up, another way to solve the problem is to use a discount rate of public company in a business that is very similar to that of the project. However, this method also has its own limitation because the problem of this method is that it is sometimes not easy to find a public company that is only in the business represented by the project. If a public company is in other business as well, the discount rate is inappropriate to evaluate the project. So for some students ask about how to prepare, want to further reading. So from now on, I'm adding the chapter in each, behind each lecture notes. So this is in chapter 13 of the textbook. Any questions here? I'm still available outside to answer the question as my consultation time. And again, I have an additional consultation hour today in the afternoon from 3 to 4. The consultation room is in H397. That would be the usual one. If you have any question, please come either after the class or in the afternoon to 3 to 4. Okay?
Test, is it going to be like fully covered all the weeks of previous line, or just
say it again?
You know, for the next week,
yes,
we're going to have an in-class test. Is it for mid semester, right?
Yeah.
So is it going to be everything, you know, for the last seven or 8 weeks?
Oh,
I
know it's going to cover part of my material, but you have to ask Dr. Nongjun.
Ah, right.
Yeah, she designed all the tests.
Okay.
I know my part has been covered, but whether the things before is also covered, you need to ask her.
All right. So is it reading of the textbook?
I would say for my part is you attend the lecture,
Yeah.
you understand the tutorial questions.
Yes. Okay.
That's pretty much you can handle.
Sure.
Yeah. That's right.
All right. Thanks.
Thank you.
All right. So, sorry, just one more question. What's your consultation time gonna be?
Yeah, this is just after this one, stepping outside.
Yeah.
1 hour.
Yeah, 1
Then another hour is 3 to 4. You can
3 to
see
4
that
time gonna be? All right.
3 to 4 this afternoon.
All right.
Yes, H397.
Hey, 397.
Yes, that's a normal consultation room.
All right. So, can I just drop in, or just have to make a appointment or arrangement?
Well, but for today, it's a little bit uncomplete because I have to grab the appointment.
All right.
Yeah.
All right. Sure.
Okay. We can get outside. Yes, because maybe there's some.
Okay.
Jackie.